story then this week is America's top central bankers gather in Washington, D.C. In what could be a historic two-day policy meeting. Markets reckon there's a 76% chance that the Federal Reserve will take the plunge and hike borrowing costs from the current record low for the first time in nearly a decade. While a hike is largely priced in, Fed Chair Janet Yellen will need her A game when she faces the press tomorrow and tries to guide market expectations from monetary policy in 2016. If the Fed does hike, though, then it will be doing so in a much weaker inflationary environment than before. According to the CNBC Fed survey, the Fed will hike interest rates this week and as many as 3 more times next year. And respondents to the survey believe it's bad for stocks, housing, and the economy. CNBC's Steve Leisman is here with the details of the Fed survey. Over to you, Steve.
Because it's the first one where we start to look through this coming rate hike. Let me dispense with the news. First off is that 95% of our 42 respondents, you can see that right down there, they expect an increase tomorrow. So a lot of this survey, the results are, what does Wall Street think is going to happen next? And let's start right away with the big question, how many rate hikes next year? What you can see from this chart is there's not a lot of consensus. Will it be 1, 2, 3, 4, or 5 hikes? 29% say 2, 29% say 4, 21% say 3, and you've got people on the 1 and 5 camp. That's what makes the Wednesday statement so important. We'll be looking for whatever guidance, of course, and the press conference, whatever guidance we can get from the chair about what happens next year. Our median is 3. It's the beginning. We'll see how that changes over time, both from the guidance and as the economic data come in. Now let's take a look at the timeline and see how that's changed. Come over here. December, in the prior survey, we were looking for rate hikes in December. That hasn't changed, of course. Now, the next most important, when is the next rate hike? New entrant here, that is expected in March on average for our 42 respondents. Balance sheet decline had been November 16. That's pushed ahead a month to December 16. That moves around this area here. So about a year out, the expectation now is that that $4 trillion balance sheet should begin. The Fed should allow it to decline. Finally, the terminal rate had been the third quarter of 18. They've pushed that a little closer, but brought the rate down to 2.58. So this is seen as a very shallow rate hike cycle over the next couple years here. Last thing we want to show you here is the path of the funds rate. And what's important about this chart is look where we started 2015 with an expectation that the funds rate would end the year as high as 1.8%. And look where we are now, an expectation we will end 2016 0.9%.
So not just a possible rate hike tomorrow, but possibly 3 next year. But not everyone is happy about the impending rate hike by the Federal Reserve. Officials in China have been urging the U.S. central bank to hold off on that rate increase. CNBC's Eunice Yoon gets us the latest from Beijing.
Chinese policymakers are bracing themselves for the Fed's next move. Just a couple of weeks ago, the finance minister was arguing against a U.S. rate hike, saying that it could be damaging to the economy and that the world wasn't ready for it. In the past couple of days, Chinese officials have been playing down those comments, but the main message here is that China is worried about a Fed rate hike. Why? First of all, as the finance minister suggested, there's concern that a rate hike could actually damage any type of recovery and hence weaken demand. And this, of course, comes at a time when China's economy is already struggling. Secondly, the concern is that a Fed rate hike could increase pressure on the yuan to depreciate. Already we're seeing the Chinese currency at a 4-year low. And even though in theory that's, of course, a positive for the exports here because it makes it much more competitive, at the same time, Chinese policymakers like control. They want to be able to manage the currency and to make sure that they don't see any destabilizing swings in the currency. Thirdly, the officials here have been expressing concern about capital outflows, especially after we saw a record in November. So overall, the Fed rate hike, or if it does indeed happen, it could just potentially complicate policymakers over in this side of the world. Guys?
And capital outflow is something that many emerging markets could be bracing for. And for more on that, now I'm joined by Nariman Behravage, the chief economist at IHS. Thanks very much, Nariman, for joining us here on CNBC TV 18's Big Picture. Let me first ask you, clearly everybody is now expecting a rate hike tomorrow, and many are saying if she doesn't, then it would just be sort of an anticlimax. How do you weigh in on this? Is it a given?
Well, we definitely think they're going to raise rates. If they don't, I think they're going to have a huge credibility problem because they've talked about this for so long, and everybody's talked about it for so long. So to me, it's a foregone conclusion they're going to raise interest rates. As you were speaking earlier, the next big question is where do they go from here? How many more rate hikes, say, in 2016? We're saying 4, but it's very important to put this in context because even at the end of 2016 and even into 2017, interest rates are going to be well below where they were, let's say, in 2006. So even these kinds of modest rate hikes don't really create a big challenge for the U.S. economy.
Right. Fair enough. I mean, but the big question many, in India and many of the emerging markets are wondering is the sort of, turbulence that could follow owing to the a possible Fed rate hike and its impact on emerging markets. Do you think that turbulence is only natural and with time, of course, things will stabilize?
There's no question that turbulence is part of the picture here. Unfortunately or fortunately, we're looking at the Fed essentially having huge influences globally. We know from past episodes of Fed tightening that there's sort of a flight to quality or flight to safety, if you want to say it that way. And so investors tend to come back into the U.S., from emerging markets. And so this has already happened to some extent. Markets have anticipated this increase. As I said earlier, we've talked about it so much that to some extent markets have already factored it in. But as the Fed continues to hike, my guess is every time it hikes one more notch, then we will see some turbulence, especially in the emerging markets. So unfortunately, again, this is sort of part of the global landscape we're facing right now.
Right, but you're saying that largely most emerging markets may have already priced it in, considering the fact that the talks of tapering and moving to sort of increasing interest rates has been going on for quite some time now.
That's correct. I mean, I think if the Fed's rate hikes are going to be gradual, which we think they are, my guess is that the damage to emerging markets will be limited. I'm not saying non-existent, but limited. Because these are small changes that we're talking about. I know it's the first time in nearly 10 years the Fed's going to hike rates. I understand that, but everybody's talking about fairly modest increases in U.S. interest rates.
Right. When you talk about, the impact on emerging markets, primarily 3 things come out. One is the impact on the domestic country's currency. 2 is the impact on their own interest rates owing to a possible Fed rate hike. And the third would be in terms of capital outflows. If I could just take one at a time, Nariman, because we've seen as far as the impact on currency is concerned, in the last 6 to 7 weeks, the renminbi has sort of weakened by about 1.8%. China has already taken steps in order to try and peg its currency, with a clutch and with a sort of group of other currencies rather than just the dollar. So you think that many emerging countries, as far as an impact, a depreciation on their currencies are concerned, is a given largely?
I think so. The most vulnerable of the emerging market currencies are, of course, those of countries that are commodity exporters, the Russias, the Brazils, and so forth. I mean, in the past 3 years, the Indian rupee hasn't been hit that hard. A little bit, but it's not a huge hit. The renminbi, of course, the Chinese renminbi is the one that's on everybody's sort of radar screen right now, mostly because China's huge. And it's, after years of upward pressure on the renminbi, we're now seeing downward pressure on the renminbi. So the worry, as you're saying, is that a Fed rate hike would put further downward pressure on the renminbi. But I think the Chinese central bank and the government will do what they need to do through sterilized interventions or other things to prevent a big collapse in their currency.
Right. When you talk about this, you of course talk about the possible capital outflow. In fact, our colleague also in Beijing was precisely mentioning this. And we've seen how the Asian financial crisis sort of triggered a larger debate about about capital account convertibility. So in that sense, how do you look at this debate as far as capital account convertibility is concerned? Because the Asian financial crisis, of course, even prompted institutions like the IMF to sort of voice their sort of concern in terms of full capital account convertibility. So do you think in that sense, capital outflow is a given for emerging markets, and thereby it increases the vulnerability of emerging markets?
Well, there's no doubt about that. And already we've seen quite large capital outflows from emerging markets. Will that accelerate or continue? Certainly it'll continue in 2016 as the Fed hikes rates. Will it accelerate? It's hard to say. But yes, unfortunately, that's sort of part of the picture here, is that capital flows out of emerging markets in these episodes when the Fed raises interest rates and into the U.S., where the yields are higher, if you will, and is still a safe asset. So again, unfortunately, that's, you know, that is a problem. I think, again, some countries more vulnerable than others, countries that are struggling. India, on the other hand, is doing fairly well growth-wise. And so I'm less worried, let's say, about India than I am about Brazil or Russia or South Africa.
Right. In fact, you know, very recently, in fact, just a short while ago, there was also this, a sort of a statement by Ben Bernanke, which came out in the form of an interview, where he said that there could also be, there is a possibility of the US Fed also in the future somewhere using negative interest rates, you know, the negative rates to basically force banks to utilize their money more, you know, much like what, you know, ECB has done recently, where they sort of brought down their rates to negative 0.3%. Do you think that is a possibility at all?
I think it's a very low probability kind of scenario for the U.S. right now, precisely because we seem to be moving in quite the opposite direction. It's a bigger problem in much of Europe because European banks are still in some difficulty. U.S. banks are much healthier now than they were, say, 5 to 6 years ago, certainly, but they're healthier than their European counterparts and more willing to lend. And so I think that imperative to lower interest rates below zero is greater in Europe than it is in the U.S. So it's always a possibility, but I don't think it's very likely for the U.S.
We'll leave it at that. Nariman, thank you so very much for joining us here on The Big Picture on the CNBC TV 18. Thank you so much for your time.